Liquidity equals value. Let me say that again because most of you are going to forget it the moment things start looking good. Liquidity equals value. If an asset can't generate free cash flow, if it can't throw off money that you can take out and deploy somewhere else, then I don't care what the story is. I don't care how good it looks on paper. I don't care what some analyst says it's worth. It's not an investment. It's a speculation, and speculation gets you killed when the market panics. I've seen it happen over and over again. People fall in love with assets that don't produce. They fall in love with growth stories. They fall in love with narratives. And then when liquidity dries up and credit tightens and everyone starts running for the exits, those assets become worthless because there's no bid. Nobody wants something that doesn't pay them while they wait. Right now, we're in a moment where the market is starting to panic. Not full-blown panic yet, but you can feel it. The cracks are showing. Interest rates are higher than they've been in years. Credit spreads are widening. Banks are pulling back. Developers are struggling. Office buildings are empty. Retail is still getting crushed. And everyone who thought real estate only goes up is starting to realize they might have been wrong. Good. This is when you pay attention. This is when you separate the owners from the speculators. This is when you figure out who actually knows what they're doing and who is just riding a wave of cheap money. I'm going to tell you something that's going to make some of you uncomfortable. Most REITs are garbage. Most of them are over-levered, under-managed, poorly allocated capital machines that exist to collect fees and pay dividends they can't afford. They're not businesses. They're financial engineering wrapped in a corporate structure. And when the market turns, when liquidity disappears, when refinancing becomes impossible, they blow up. I've watched it happen in every cycle. The REITs that survive, the ones that thrive, are the ones that understand what I'm about to tell you. They're obsessed with free cash flow. They're disciplined about leverage. They own assets in markets with real supply constraints and real barriers to entry. They don't chase yield. They don't overpay for acquisitions just to show growth. They're run by people who have skin in the game, who think like owners, not like hired managers playing with other people's money. Now, I'm going to walk you through what to look for in a REIT when the market is panicking, and I'm going to give you some names worth watching. But understand this. I'm not telling you to buy anything. I'm telling you what I'm looking at, what I'm analyzing, what separates the survivors from the casualties. You need to do your own homework. You need to understand the fundamentals. You need to look at the balance sheet, the debt maturities, the occupancy rates, the lease structures, the management track record. If you're just looking for hot tips, you're in the wrong place. I'm interested in making money, not making friends. Let me start with what matters, replacement cost. If you can buy a REIT that owns assets trading below replacement cost, you're already ahead. That means even if the market stays bad, even if prices don't recover quickly, you're buying something that would cost more to build today than what you're paying for it. That's a margin of safety. That's protection. Most investors ignore this completely. They look at price to FFO ratios. They look at dividend yields. They look at price momentum. None of that matters if you're overpaying relative to what the assets are actually worth. I want to own things that are cheap relative to what it would cost to replicate them. That's the foundation. Next, barriers to entry. I want REITs that own assets in markets where you can't just build more supply easily. That means regulations, zoning, physical constraints, permitting nightmares, all the things that make it hard for competitors to come in and drive down rents. If you own apartments in a market where anyone can throw up a new building in 6 months, you don't have a business. You have a commodity that's going to get competed away. But if you own industrial properties near ports where there's no land left, or you own data centers in markets with power constraints, or you own cell towers that nobody else can build because of local opposition, now you've got something. You've got pricing power, you've got durability, you've got a reason to exist beyond just financial engineering. Free cash flow, I cannot emphasize this enough. The REIT needs to generate cash after all expenses, after maintenance, CapEx, after everything. And that cash needs to cover the dividend with room to spare. I don't want to see 95% payout ratios. I don't want to see dividends funded by asset sales or by issuing new shares or by taking on more debt. That's not sustainable. That's a Ponzi scheme with a corporate wrapper. I want to see conservative payout ratios, retained cash flow that can be reinvested or used to pay down debt, and a management team that isn't desperate to keep the dividend at all costs just to keep the stock price up. If a REIT has to cut its dividend, fine. I'd rather see that than watch them destroy the balance sheet trying to maintain something they can't afford. Leverage. This is where most REITs get into trouble. They lever up when times are good because it gooses returns and makes management look smart. But leverage is a double-edged sword. It amplifies gains on the way up and amplifies losses on the way down. And when credit markets freeze, when lenders get scared, when refinancing becomes impossible or prohibitively expensive, leverage kills you. I want to see low loan-to-value ratios. I want to see staggered debt maturities so they're not facing a refinancing cliff. I want to see unencumbered assets that can be used as collateral if they need liquidity. And I want to see management that talks about leverage as a risk to be managed, not as a tool to maximize returns. Management quality. This is the hardest thing to assess, but it's maybe the most important. You want people who have been through a downturn before. You want people who have skin in the game, who own a lot of stock, who are aligned with shareholders. You want people who are capital allocators, not just operators, because when the market is panicking, the decisions you make determine whether you survive or die. Do you sell assets to raise cash? Do you buy distressed assets from weaker competitors? Do you pay down debt? Do you return capital to shareholders? These are not easy questions, and the wrong answer can destroy decades of value creation. I want to see a track record of smart decision-making under pressure. I want to see humility. I want to see people who understand that real estate is cyclical and that arrogance gets punished. Now let me talk about sectors, because not all real estate is created equal. Some sectors are in structural decline. Some sectors are facing temporary headwinds. Some sectors have tailwinds that are going to last for decades. You need to know the difference. Industrial and logistics REITs. This is one of the few sectors I actually like long term. E-commerce is not going away. You need warehouses, distribution centers, last mile facilities to make e-commerce work. And you can't build these things just anywhere. You need to be near population centers, near transportation infrastructure, near labor pools. The good industrial REITs own assets in supply-constrained markets with long-term leases to credit tenants like Amazon and Walmart. The bad ones overpaid during the pandemic when everyone thought e-commerce was going to grow at 30% a year forever. It's not. Growth is slowing, but the structural trend is still there. I'd be looking at Prologis. They're the biggest, most sophisticated industrial REIT in the world. They own the best assets in the best markets. Their balance sheet is fortress-like. They've been disciplined about not chasing deals. And they're run by people who understand the difference between growth and profitable growth. Are they cheap? Not particularly, but quality rarely is. If the market panics and their stock gets hit, I'm paying attention. Data centers. The AI boom has everyone excited about data centers. And there's some truth to it. AI requires massive amounts of computing power, which requires data centers. But here's what most people miss. Data centers are incredibly capital intensive. They require huge amounts of power. They require cooling. They require fiber connectivity. And not every market can support them. There are real constraints, and those constraints create barriers to entry. I like Digital Realty and Equinix. They're the two dominant players. They own assets in markets where power and connectivity are available. They have long-term contracts with hyperscalers like Microsoft and Google, but they're expensive. Everyone knows the AI story. The question is whether the current valuations already reflect all the good news. I'd be watching for a pullback. If the market panics and these get sold off, that's when you buy. Cell towers. This is a boring, beautiful business. People need wireless connectivity. That need is only going up as data usage increases. And cell towers are essentially monopolies in their specific locations. You can't just build another tower 100 feet away. The carriers need the infrastructure that's already there. American Tower and Crown Castle are the big players. They have long-term contracts with the major carriers. They generate predictable cash flow. The risk is that 5G deployment slows down, that carriers reduce spending, that growth stalls. But even if growth is low, these are high-quality assets generating cash. If they get cheap, I'm interested. Apartments. Multifamily is tricky right now. On one hand, housing affordability is terrible, which means more people are renting. On the other hand, a ton of new supply came online in the last few years, especially in Sunbelt markets. So you've got this dynamic where demand is strong, but supply is overwhelming it in some markets, and rents are flattening or even declining. I'm cautious here. I'd be looking for REITs that own in supply-constrained markets like California, where it's almost impossible to build. Avalon Bay and Equity Residential own in coastal markets with high barriers to entry. They're well managed. They have strong balance sheets, but I'm not rushing in. I want to see how the supply situation shakes out over the next year or two. Self-storage, the sector got way overbuilt during the pandemic. Everyone thought we needed more storage because people were moving and accumulating stuff. But demand has cooled and supply is everywhere. Public storage is the king of the sector. They're the most disciplined operator. They have the best balance sheet. But even they're facing headwinds. I'd wait for a better entry point. Same with Extra Space Storage and CubeSmart. Good companies, tough environment. Retail. Everyone thinks retail is dead, and a lot of retail is dead. Malls are dying, department stores are dying, but not all retail is the same. Grocery-anchored shopping centers are doing fine because people need to buy groceries and they want convenience. Open-air lifestyle centers in affluent areas are doing fine because experiences can't be replicated online. Realty Income is the biggest net lease retail REIT. They own single-tenant properties leased to everyone from Walgreens to Dollar General to FedEx. Their business model is boring and predictable. They call themselves the monthly dividend company, and they've paid dividends for decades. Are they exciting? No. Are they safe? Relatively. If you want yield and stability, they're worth watching. Same with Agree Realty and National Retail Properties. But understand, you're not getting high growth here. You're getting income and stability. Office, stay away. Just stay away. Office is a disaster, and it's going to stay a disaster for years. Work from home is not going back to 2019 levels. Companies are shrinking their footprints. Occupancy rates are terrible. Valuations are cratering. Lenders are panicking. Unless you're buying distressed office debt at 30 cents on the dollar with a plan to convert to residential or redevelop, there's no reason to own office REITs right now. Boston Properties is the highest quality office REIT, and even they're struggling. Vornado is a mess. SL Green is dealing with New York City office, which is ground zero for the crisis. Maybe in 5 years there's an opportunity, not today. Hotels, another cyclical sector I'm cautious on. When the economy slows, travel slows. When travel slows, hotels suffer, and we're seeing signs of economic weakness. Host Hotels and Parnassus are the big lodging REITs. They own luxury and upper upscale properties. They don't have the operational complexity of running hotels because they lease them to operators like Marriott, but they're exposed to business travel and leisure travel, both of which are cyclical. If we go into a recession, hotels get hit hard, but if we avoid a recession and the economy stabilizes, they could do well. I'd be watching for panic selling to create an entry point. Healthcare, senior housing, and medical office buildings. This is a sector with long-term demographic tailwinds. The population is aging. People are living longer. They need healthcare services. They need senior housing. The problem is that healthcare real estate is operationally complex. It's not like owning an apartment building. You're dependent on the operators who lease your buildings. If they go bankrupt, you're in trouble. Welltower and Ventus are the two big players in senior housing. They're well managed and have diversified portfolios. Healthpeak focuses more on medical office and life science buildings. The sector is not cheap, but the long-term trends are solid. If the market panics and these get sold off, I'd look closer. Now, let me tell you what almost nobody is paying attention to. Everyone's worried about office. Everyone's worried about recession. Everyone's worried about interest rates, and those are real concerns. But the big distortion forming right now is in the commercial mortgage-backed securities market. You've got hundreds of billions of dollars in CMBS loans coming due over the next few years. And a lot of those loans are backed by properties that are worth way less than the loan balance. Office buildings, retail properties, even some apartments and hotels. The properties can't refinance at current values. The owners are going to walk away. The lenders are going to take the properties back. And those properties are going to hit the market at distressed prices. The REITs that survive this, the ones with cash and access to capital, are going to be able to buy these assets at a fraction of replacement cost. That's the opportunity. That's what I'm watching. The REITs with strong balance sheets, low leverage, undrawn credit lines, and smart management teams are going to be able to deploy capital in a target-rich environment. Prologis in industrial, realty income in retail, digital realty and data centers. These are the names that can go on offense while everyone else is playing defense, and that's how you create long-term value. But here's the thing, you don't buy today, you wait, you watch, you let the panic develop, you let the distress surface, you let the weak players fail, and then you act. Patience is the hardest part of investing, but it's also the most profitable part. Everyone wants to be early, everyone wants to catch the bottom, but you don't get paid for being early, you get paid for being right. And right now, the right move is to be liquid, to be patient, and to be ready. So what do? You make a watch list. You track these REITs. You watch their debt maturities. You watch their occupancy rates. You watch their dividend coverage. You watch their stock prices. And when the panic intensifies, when the selling becomes indiscriminate, when quality names get thrown out with the garbage, that's when you start buying. You don't buy all at once. You scale in. You buy a little, then wait. You buy more if it goes lower. You average in over time, because nobody knows where the bottom is, but you can build a position at prices that give you a margin of safety. And remember, the goal is not to buy the most REITs. The goal is to buy the best REITs at the right price. Quality matters, management matters, balance sheet matters, barriers to entry matter, free cash flow matters. If you focus on those fundamentals, if you ignore the noise, if you're disciplined and patient, you'll make money. Maybe not this quarter, maybe not this year, but over time. And that's the only time horizon that matters. Stop chasing trends. Stop listening to analysts who are just trying to generate trading commissions. Stop believing that this time is different. It's never different. Supply and demand always win. Cycles always turn. Discipline always beats speculation. Understand the numbers. Demand free cash flow. Look for value where everyone else sees trash. That's how you win. If you want to think like an owner instead of a speculator, if you want to understand what actually matters when the market is panicking, hit subscribe, hit like, and leave a comment. Tell me what REITs you're watching. Tell me where you think I'm wrong. I'll try to respond honestly, even if the truth is uncomfortable, because that's the only way any of us get better at this.